Morning, everybody. Mike Courtney, Mass Mutual, Eastern Pennsylvania Brokerage Director. I'm here on a beautiful beginning of June. Can't believe that. Wednesday morning with my good friend and counterpart, Steve Parisi, President and CEO of IBC Global. Steve, good morning.
Good morning, Mike. How are you, my friend?
Cheers. Doing good.
Good.
Steve and I are having a conversation that we're going to bring everybody in on about in-force policies and policy performance and projected versus actual results. I'm actually in the process of packaging up all of my family's policies, the original sales illustrations, current projected illustrations, and some policy statements for Steve and his team so they can, add that to their database. We really do like to keep track of what happens in real life. A lot of times we get so focused on illustrations and projections that we forget about real actual results. So Steve, I know that you do a ton of research in this area. A lot of times it's info. Why is this information so hard to obtain?
Yeah, that's a good question. I don't know. Well, I've got my suspicions, but I don't have a definitive answer as to why getting information on how cash value has performed in whole life insurance policies, talking about reality, not just projections, because you can look at illustrations and they often project great looking values and people want to buy whole life insurance because of it. And then you can look at consumer reports and people that are for whole life or against whole life and state that it produces between 1% to 2%. And here's proof of it, right? Because they've got a policy that produced 1% over a 20-year period or something like that. And why on earth would I do this? But then we have historical policies that we're able to dig into and get our hands on just over the years that have produced north of 4 or 5, even 6%. So they can deliver, but to get that information, you really have to know what to ask for, and you've got to be persistent in asking for that information. And some companies disclose it. Like we've discussed this before. We've gotten historical policies, real performance from 4 companies. That's the 4 major mutuals: Mass Guardian, New York Life, and Northwestern Mutual. That have delivered north of a 4% internal rate of return. One other company.
How did they disclose that information to you? Is it just redacted policy information, or it looks different than that?
Yeah, no, it looks a little different than that. So how we've gotten a lot of the information, to answer your question, is we've gotten policies from people we've been working with that have a policy on their dad, or a client that has
like what I'm getting ready to do now with so you got somebody who's got a policy that's been in force for 10 years, 20 years, whatever it is.
Yeah.
Do you still have the original sales illustration? Can we use this got it.
Correct. So what I do at a minimum is to see, okay, how much was paid in, you can get the cost basis. Can we get the exact dollar amount that was paid in each year? That helps measure the actual internal rate of return. And then what has the policy actually produced? I've paid in $100,000. I have $100,000 that's 0%, or I've got more than 100. Hopefully it's not less. Yeah. But when we can get actual statements, actual policies where we can see what's actually occurring, that's what I'm interested in. So we get it from people that we work with. What helps a lot is one case in particular. This one just comes to mind. We obtained servicing rights for the policy. It was with a life insurance company that is really up to speed with respect to their technology. The policy was issued in 2007. I was in college in 2007. I wasn't in the business. So what we're able to do is obtain the original sales illustration, the annual statements, what he actually received each year in cash value, dividends, everything, and then really measure what had actually happened over time. And it was one of those perfect cases where what he planned on doing from day one, he set it on autopilot and did just that. So we got to see what was projected and what actually happened. That's the kind of stuff that's most valuable because we can get all of the information. But just as I say that, I mean, that's a lot of work to go back and get the statements every year, and then you've got to export the data onto Excel each year, triple check it to make sure everything's accurate. It takes some time. So that could be one reason why companies don't have it. I know they say it doesn't come up a whole lot, measuring the cash value performance, but there could be a number of reasons behind it.
Right.
Yeah.
Okay. So that was part of my question. Is there real historical data that you've received directly from the carrier where it wasn't an agent of record type of situation?
Yes. Yeah. I've gotten that, to be specific, from Mass Mutual, the couple of historical pieces that you've sent, policies that were issued as far back as 1980, some a little bit more recent, Northwestern Mutual, and Guardian.
Okay.
New York Life, I can almost bet that they have those similar pieces, but we've got independent policies from them.
What's I guess I have a couple of questions. How has this helped? I mean, I think I know the answer, but like, how does this help you in your process or your day to day? I mean, I know one piece of it is giving you and your clients the peace of mind of knowing that, the companies that we're dealing with, we're really able to track results. And we're not working with anybody who we're not able to find real historical data on. So that's peace of mind component, but I know it's got to be more than that.
Yeah. So where that comes from is when you look at cash value life insurance, whole life in particular, and where people get upset, consumers. So someone puts in 10 grand per year or $500,000 per year into a policy. Where they get upset is where they have expectations. They're told by the agent that this should perform quite well, similar to what you see on the illustration on the non-guaranteed value side. And then it doesn't deliver. It under-delivers. The people get ticked off. A financial advisor tells them, well, you got ripped off with this. Emotions get involved and they say, I'm done with it. I feel like I was taken advantage of. And whether it's true or not, that's how people feel. So we've got to address that. So how I look at it is, okay, taking emotion out of it, what has been factual? Like, what do corporations do? What actually works? If we're going to sell a whole life insurance policy for maximum cash value, what I've seen on a delivery standpoint, where clientele does not have buyer's remorse, they don't come back feeling like they got taken advantage of, is when the product delivers. And when it's designed properly. So when we set policies up with the minimum base premium, maximum PUA design with those major mutuals, like that's where I've seen it deliver the strongest results. And, if I go back in the day when I was first trying to get things going, I remember meeting with people online all the time. It was over a GoToMeeting was the app I used back then. And my fear, because I was a young kid trying to get things going, was I'm going to show them a design and they can work with their local agent who's probably a lot older than me and more experienced. So I could just do all the work and then they could just
they're going to take this illustration and just roll.
Correct. So a way to prevent that is just to design it with absolute maximum cash value from the get-go. And then if they try and take it somewhere else, like, hey, that thing's maxed out. Like there's nothing I can do. And so that's from an illustrative standpoint. But at the same time I was doing that, when I was starting to get going, when I started that, I was at the tail end of still working at the firm where I design policies in the back office for corporations. So literally what we're doing for executive benefit planning was doing that for individuals. And that was the design I knew worked. So I went with that. And that was it. Like we knew it would work. I knew it would work.
Side note, isn't it funny that GoToMeeting sounds so antiquated?
I know, right? Yeah. We're on Zoom now. Yeah. They didn't keep up with the times, I guess.
So what kind of trends have you seen when you're looking at this kind of data?
That's a good question. What I've noticed the most, and I'm going to do my best not to get overly technical here, is when policies are issued, someone's starting a whole life insurance policy, the higher that base premium is, so money can go toward the base premium or PUA rider, the higher the base premium is, the greater the chances are of that policy under delivering. And that's purely based on experience and viewing actual results. The higher the PUA payment is with a particular policy, the greater the actual results have been. What's interesting is you can dig into that in illustrations. Whenever you look at the guarantees or conservative dividend, particularly the guarantees, where you can't see any non-guaranteed elements, which are what ifs really when you look at it, you'll see every single time a low base premium generates stronger cash value for the consumer, for the policyholder. If I go with a higher base premium on an illustration, what that sometimes does, depending on the company and product, is produce long-term, 40, 50 years down the road, more money potentially for the policyholder than a low base premium policy. And that can be intriguing, for some consumers that are strictly focused on the long term. It can be very intriguing for agents because we can 10x their compensation in some cases.
But it's not we've talked about this before, it's not a 10, 15 year long-term outlook. It's a 30, 40, 50 year long-term outlook.
Correct. So it's 40 to 50 years long-term. And the big issue with that is the first piece that I mentioned is on an illustration, you might see greater long-term results, but then the actual results end up being less. So if it under delivers and you've got a greater chance of that happening with the higher base premium, now it's like I picked this option because I wanted more money long-term, but now because of variables outside of my control that the insurance company ultimately decided what happens with my policy, I have less money. So I made a bet and it didn't pay off. It's like, great, now I'm stuck with it with this high base premium and high commitment. Does that make sense? I talked a lot there. Okay.
Yeah, no. So, basically just the historical data that you've seen looks generally like you're getting better cash value performance from a blended policy where there's a smaller base premium. And from a Mass Mutual perspective, there's ALIR and LISR blended in there. But you do see long-term, long outlook, obviously depending on a variety of factors, could be 30 years, could be 50 years, that all base premium cash value will catch up and then surpass the other. But it's interesting that it is that way. And I think what you said at the end is most interesting, so that all of this is uncertainty and you're not really sure. But then at the end of the day, with that 100% base premium, then you're still sitting with that commitment.
Correct. Right. Lack of flexibility.
Yeah.
Mm-hmm.
Yeah. What does this look like from a when you guys receive all this information and data? What does the output look like on your end? This becomes part of your database library? Yeah. Have you turned this into YouTube videos? Is this on the ILS site? What's the format for all that?
Yeah. So our historical performance study, which is always being updated and we're including new policies once I review them, create everything and approve it, we always add those to the study. So it's on ILS for subscribers. It's not public on YouTube. We've got a couple videos here and there that speak to it, but the full analysis is not public. Yeah. We do provide that to our clients. It's in our client user package, and we send them links as well. But we've got to have their contact info. If I just send you the link to watch it, it's going to say restricted unless we actually unlock it based on the info we have.
Like an eyeball scanner.
The eyeball scanner, yeah, for a life insurance policy, right?
Right. Well, if you want to see real historical data, we're going to scan you.
Yeah, exactly. Well, because it took a lot of time to put together.
Oh, yeah.
Yeah, we do provide it, and we do have some of it for free as well. Yeah. Because I don't want to just withhold and say it's $1. No, we want to give it to everyone. But for the detailed stuff that mostly agents want to understand how that works, and some clients that we do have available for clients.
Yeah, I would think clients would.
Yeah.
I don't think clients even know or understand that this is what they want to see.
There's some truth to that. Yes.
I'm consistently amazed by and even like sophisticated advisors who just like look at illustrations. I mean, that's their sales tool. My former general agent, our dear friend Walter, had a great, he said, the only thing I can guarantee is that this policy is definitely not going to look like this. Like that's the only thing that's guaranteed with these non-guaranteed illustrations. It's not going to look like this.
Correct.
Down the road.
Yeah.
So that's always a tough one, comparing illustrations, and especially if you're dealing with a carrier like how you're talking about that, where you can't get real historical data. It makes me uneasy. That should be a lot easier to obtain. Real historical performance, not dividend performance.
Correct.
If I put $1 into this every year, what does it really look like after 10 years, after 20 years?
Correct. Yeah. No, I mean, it's always games trying to get it, which the short answer, like my father would just say, that means they don't have it. Simple as that.
Sometimes I do think that some of these companies are so behind from a technology perspective, or struggle with, like, they're still locked into old systems and trying to build out new systems, that I do think it's either a struggle to get it, or somebody at the home office level has to go out and literally be obtaining client sign off to release information, which they're not even willing to ask to do. So sometimes it is just they can't get it, but there should be a mechanism in place for people to stand by their performance.
Yeah.
If their performance is less than, as an educated member of the financial services community, I know that actual performance is not the same as illustrated performance.
Correct.
And we're assuming that, but let's see what it looks like.
Yeah. And another thing I guess I would think about is, imagine if you're the CEO or you own a smaller life insurance company, and if that information gets out there that your policies don't deliver as illustrated, or they're significantly worse than some other carriers, that gives you a huge disadvantage.
Yeah.
It does. Like, why is someone going to go with you when they see clearly like you haven't delivered? It's going to cause an issue there. So that, who knows? Like that can be the case with anything. But just when you look at actual performance, it's difficult to get. And a lot of times there's games that are played around it, like, oh, you mean dividend history, or don't even look at the cash value. It's not about that. It's about best benefit and everything. It's like, listen, it's people's money. This is what they're interested in. If they ask a question about something, we're going to directly answer that question to the best of our ability. We're going to provide data as well. Simple as that.
And how do you monitor this ongoing? I mean, you're just regularly following up and trying to get updated. Yeah.
That's fun. Yeah. So ongoing. So when we put a policy.
Well, at least if you lock into a source with one of these carriers, where you can you're like, all right, this is our.
Yeah, that's fun. And too, with the major mutual carriers, like if I take Mass or Guardian, for example, it's very easy to track performance with the policies that we put in place.
Sure.
Which, I guess I'm getting older. I'm
30 years in, or?
I'm in my over 10 years, so in my 11th year, licensed in the business with this particular type. I mean, we've got policies that are going on 10 years old that I put in place. So that's sweet now that we can actually track the performance.
Well, now it's going to start getting easy with
Yeah, and with the technology too, with those two. If you take Mass and Guardian, for example, I can go back. It takes a lot of time, but I can go back and pull the transaction history. I can pull the annual statements, which I'll do, and then it's a lot of information with in-force illustrations, annual statements, original illustration. It's like, all right, here you go. And okay, let's condense it. Then I'll put it on Excel or some kind of simplified format, and then walk through to see, here's what was projected, here's what actually happened. And then once you've got it complete, as long as you keep up to speed with it, it's very easy, because I can just download the annual statement each year. If I adjust payments, I want to take that into consideration. And I track the performance year over year. And that's where we've seen it. We've seen it deliver. which is fantastic, right? Where policies are projected to break even between years 4 and 5, and they break even between years 4 and 5, even with the dividend decrease. Consumers happy, like, all right, it's doing what I want. Like, let's keep going.
Yeah, the trend is solid cash performance.
You don't have to resell it.
Solid break even time frame, continued death benefit growth. Well, you don't have to resell it because you guys aren't overselling and you are over educating up front.
Yeah.
So I think that's really critical for less issues and less complaints and less moaning and groaning from consumers down the road.
Yeah, that, and we can talk about this another time, just how to always up your game at the business with business. How I look at it is, how do you treat your clients like American Express treats some of their high-end clients, right? Everybody wants the high-end credit cards that you actually have to pay for to get. Yeah. You've got to pay higher fees. Like, how do they do that? So, okay, if you want this, you'll be part of this club, you've got to pay more money to get in. If you look at a high-end restaurant where it's all about presentation, they treat their clientele, it's like royalty and everything. Doing that with business, in addition to everything else, right? There's a lot more to it. That goes such a long way. And it's a nice way to position yourself. If you say, hey, I only want to work with certain people, or only a certain number of clients each year, because you can only take on so much capacity with your team. If your service is phenomenal, you can do that. If it's not phenomenal and you're slow to get back, you can't do that. It's not going to work. You're going to get frustrated. They are, but we can talk about that another time, or I'll keep talking.
Absolutely. Yeah. So anybody out there who wants to learn more about Steve and IBC's historical performance studies, I can tell you that these guys, everything that they do is really in-depth and complete. And they take a lot of pride in that. I think it's really important because a lot of times in this business, everything just kind of gets summarized and estimated, and, tend to kind of gloss over a lot of details. At the end of the day, as a consumer, I'm much more interested in reality and what these things eventually will look like down the road. Even though I know it's, we're talking about non-guaranteed performance. It's nice to see some backup for all these conversations. So if you'd like to learn more, feel free to reach out anytime. Steve Parisi, IBC Global. My name is Mike Courtney, Mass Mutual Eastern PA, and I hope everybody has a great week. Thanks, Steve.
Thanks so much, Mike. Enjoy.